Hello class, this is Dr. Fenton. In this video, we are going to cover Chapter 4, which discusses cash and internal controls. Let's get started. The first part talks about internal controls. Now, our goal is to prepare accurate financial statements. Sometimes that doesn't happen. So as you read this part of the chapter, you'll see that sometimes errors are made. And if errors are made, then when they are identified, the statements will be corrected. Other reasons we don't have accurate financial statements will be because of fraud. Now, fraud will be intentional misrepresentation of the statements or just plain old stealing from the company by other people. Internal control is to prevent both of these, hopefully have accurate statements, avoid errors, but it's really concentrated on the fraud. So a fraud occurs when a person intentionally deceives another person for personal gain or to damage that person. And you can substitute person here for business and so forth, but there is a lot of fraud going on out there in the business world. One group estimates that on average, companies lose 5% of their total revenues due to fraud. So if you were to apply that to the Regal Entertainment Group, then 5% of total revenues would be nearly $150 million lost to fraud in a single year. That's just for one company. I mean, there are billions and billions of dollars lost in fraud every year. Now, what happens when fraud occurs? Usually there are three items here that are all present. This is called the fraud triangle, what you see at this point. There's the opportunity. So there's a situation that allows the fraud to occur. Someone has access to the cash. Maybe they have access to the accounting records where they can hide their theft. So the opportunity is there. There's the motivation. Someone feels the need to commit fraud. Maybe they feel like they need money for a gambling habit, a drug habit, or something else. Maybe they think that maybe they can get by with it. Who knows? Rationalization. There's the justification. They feel like sometimes they deserve it. Maybe they feel like the company's not paying them enough, so they don't mind stealing something from the company. So if you have all these three items present, then there is a more likely chance that fraud will occur. So this is the fraud triangle. Now, what is internal control? Well, internal control, you can see I have highlighted here, a company's plan to, first of all, safeguard the company's assets. So you want to safeguard the cash, the inventory, the property, plant, and equipment, and so forth. And then number two, improve the accuracy and reliability of accounting information. Back in the early 2000s, there were two corporations that were involved in fraud. The people in these corporations were intentionally misrepresenting the numbers in the financial statements, and it caused a lot of people to lose a lot of money. Now, the company names are Enron and WorldCom, and just WorldCom itself intentionally misclassified certain expenditures, turned them into assets instead of expenses, and so they overstated assets and profitability by $11 billion. That's just one company. And then Enron, it had a lot of problems itself. People lost a lot of money. And so just with those two companies, investors lost nearly $200 billion as the stock prices dropped. Employees lost their jobs, and so there were a lot of problems that occurred because of just those two companies. There were other companies with fraud going on at the same time, but those were the two big ones. Now, what happened in 2002 then, Congress passed what's called the Sarbanes-Oxley Act. And for short, people do call this SOX. So if you're in a company and they're talking about accounting terms or internal control or whatever, and they say SOX, they probably mean the Sarbanes-Oxley Act. So what does this act is comprised of? So the provisions, I have three of them highlighted here. The first one is the Public Company Accounting Oversight Board was established. It now has the authority to establish standards dealing with auditing, quality control, ethics, independence, and other activities related to audited financial statements. The board members are appointed by the Securities and Exchange Commission. The second one says that corporate executives must personally certify the company's financial statements and financial disclosures. And so this did not happen before, and sometimes the CEO and CFO said, I didn't know what was going on. It's not my fault that fraud was committed. Well, now they are personally responsible for these statements. And let's skip to the last one here, internal control. Section 404 of Sarbanes-Oxley requires that company management document and assess the effectiveness of all internal control processes that could affect financial reporting. And B, that company auditors express an opinion on whether management's assessment of the effectiveness of internal control is fairly stated. Of course, smaller companies are exempt from this. So those are the three provisions of SOX that I want you to remember, those three there. Let's go down a little bit. I guess that's the end of that section. Next section, framework of internal control. Let's touch on just a few points in this section. Now, as noted earlier, internal control is a company's plan to safeguard the company's assets and improve the accuracy and reliability of accounting information. In other words, the income statement, balance sheet, equity statement, and cash flow statement. Don't worry about this part right through here. Let's see what I have highlighted next. Now, one item of internal control is, an example here is separation of duties. You do not want the same person having control over various parts of the company, like the transactions, the recording of transactions, and controlling the related assets. So you want to separate the duties out if you can. Larger companies can. They can afford to hire more workers. Smaller companies have a hard time doing this. So you don't want the same person handling cash who can also make the records, enter information in the records about cash, make deposits, write checks, and reconcile the bank account. You do not want, if at all possible, the same person to have all those duties. Separate those out. In a theater situation, customer walks in the door, you have the employee selling a ticket. And we've all done this. We buy the ticket at the counter, we walk through, another employee collects the ticket. Now, if you had the same person selling the ticket and waving you on through, then that person could not ring up a sale, take your cash, wave you through, and put the cash in his or her pocket. But having two different employees with two different job functions, this sets up better internal control. Then later on, you have a different employee depositing the cash, and then a different employee recording cash in the accounting records. So you try to have, in this case, at least 4 different people involved in the process. Another example of internal control, this is a detective control, will be reconciliations. So management should periodically determine whether the amount of physical assets of the company, this can be cash, inventory, and a lot of other things, agree with the accounting records. And so you can see the next highlight, accounting personnel should routinely reconcile the company's cash records with those of its bank, in other words, the bank statement. Any differences need to be investigated. That's what we're going to do here in a few minutes. We're going to go through a bank reconciliation where we make sure that the bank statement agrees with the accounting records. We'll have differences to account for, so we'll see how to do this. Now, again, who's responsible for internal control? Again, the top executives. They take final responsibility. So the CEO and the CFO, the Chief Executive Officer and the Chief Financial Officer must sign a report each year assessing the internal controls, whether they're accurate or not. And then one thing about internal controls, you can have the best internal control setup possible, but if you start getting employees to collude to bypass those checks and balances, then fraud still could occur. So this is a weakness of internal controls, collusion. So 2 or more people can start bypassing the procedures. Next section, cash. So let's see what goes into cash. And as I'm sure you're aware, cash is the one asset that's most susceptible to employee fraud. It's there, easy to grab, put it in your pocket, and if you're in the position to put cash in your pocket and enter numbers into the accounting records to hide your theft, then that is weak internal control and the company will lose money. What goes in the cash account? We're going to start calling this cash and cash equivalents. At least the large companies do. If you look at an annual report from a company, the first asset listed will be cash and cash equivalents. Now, the amount of cash includes currency, coins, balances and savings and checking accounts, and other items you have for deposit, like checks from customers. Also, cash includes something called cash equivalents. These are short-term investments that have a maturity date no longer than 3 months from the date of purchase. Examples: money market funds, treasury bills, and certificates of deposit. So if you see the term cash and cash equivalents, this is what's going into to that account. So all these items, and if you had them, CDs and money markets and so forth. So that is your total cash balance. How much cash is enough? Well, a company needs cash to pay suppliers, pay employees, pay utilities and so forth. And they also would like to have cash available to make a quick purchase of another company if another company becomes of interest to them. They might want to buy the company before creditors do. So you want to have enough cash for possibilities, but if you have too much cash sitting in the cash account, then you're losing money on potential investments you can make, like either high rate of interest or, place some money in the stock market. Stock market hopefully would go up. And so if you have idle cash, that's not good, but you need to have enough cash. Okay, next section, cash controls. Don't worry about this too much, this section, so let's skip it. Next one. Bank reconciliations. Here we go. Now each month, you will receive a bank statement from your bank, either electronically or in the mail, and hopefully, at least you've attempted to reconcile the number the bank has with the number you have in your, like your checkbook. Okay. A company will do the same thing, except the company will check the balances of the bank statement and compare that to its cash account balance. There are almost always differences, not that there are errors, but there are differences just because of what are called timing differences. And this occurs when the bank might record something before we do, and we don't know about it until we get the bank statement, or we might record something before the bank does. We might write a check, send it out to someone, but it takes a while, maybe a long time, for them to actually deposit it and get back to our bank. So we've already reduced our cash account by the amount of the check that we wrote and sent out, but the bank doesn't know about it yet until it receives it later on. So there are timing differences we need to locate when we try to reconcile the bank statement balance of cash to the company's cash account balance. Now let's go through an example. Here is the cash account records of a company. You can see we have 3 different deposits that went in. Here are the amounts. There are checks written, so we have several checks. Looks like 5 checks written. The dates, what they're for, and the amounts. And so cash came in $77.80, cash went out $8,700. If we started the month with a $3,800 balance in the cash account, and we had the cash receipts, cash disbursements, then on our records we're showing an ending cash balance of $2,880. Again, this is in our books, in our cash account. Now we receive the bank statement at the end of the month. Let's take a look at this. First thing we notice is the bank says we have $4,100 in the bank account. Well, we only have $2,880 recorded on our books. The bank says we have $4,100. We have to find out what the differences are, and in a lot of situations, make entries for those differences. We have to make sure those reconcile. Let's see what the bank says came through. We have some deposits. Here's a note deposit. We didn't see that in our records, the $3,000 note deposit, not up here. We have interest we earned on the checking account. Checks came through. You can see all the checks did not come through. We wrote 5 checks. I only see 3. We have an electronic funds transfer where we paid for something electronically. Looks like a customer check was sent back to us. This is a non-sufficient fund check. And let's see, down here they show you what the letters mean. NSF, non-sufficient funds. That's a customer check sent back to us. DC, a debit card. So we use a debit card. And the SF is the service fee. So we have things the bank has recorded that we have not recorded yet. Both deposits and checks. So let's start accounting for these differences. We look at our records. We had 3 deposits we recorded. We only see 2 of those coming into the bank statement. This last one was made too late in the day. It did not get on the March statement. It'll be in the April statement, but not on the March statement. This is called an outstanding deposit. We look and see the bank has some deposits that we don't have recorded yet. This is a note, and if you look at the information down below here, I'll let you read it in the book there. This is a $2,800 note receivable someone owed us, and a $200 interest on that note. And the people paid the bank directly to our account for us. The bank recorded this $3,000 deposit related to the note and interest. We did not. And also we have interest the bank has put into our account. We don't have that recorded yet either. So these are differences just related to revenue, or I guess you should say cash inflow and outflow. Now on the checks, we have 5 checks written. We have 3 that we've identified. 2 of them, the $1,200 and $900, have not come through as of the end of March yet. Those are checks outstanding. And the bank has a difference here. Look at this check number 294. We wrote down that the check was for $2,600. The bank has it was for $2,900. Now, upon investigation, you find out that the bank is right. We recorded the incorrect amount in our accounting records. So we recorded the check for $2,900. That's accurate. But I guess we got in a hurry. When we went to the accounting records, we only wrote down $2,600. So there's an error that we have to account for. It's the company error, not a bank error. We have the electronic fund transfer that we paid for something, the non-sufficient fund check returned to us, the debit card, and the service fee. So these items that we have not recorded yet, we'll need to get these recorded in the accounting records. So let's see what the bank reconciliation will actually look like. So the bank said we had $4,100 at the end of the month. We had that one deposit that we've recorded. We made it on March 31st. The bank doesn't have that yet, so we're going to add it to the bank side of this. You know, it's not an error. We're just going to add it to the bank side. We recorded it correctly. It has not come through the bank statement yet. Checks outstanding. These are checks we wrote during March that did not clear our bank account during March. So we're going to reduce this from the bank side. So this side, based on what the bank says we have in the checking account, add what we know is coming in, subtract what we know is coming out, then we should have $4,200 available to us. Now let's look at the company cash balance. We start first of all with the general ledger cash account balance, $2,880 in our books. Now we start adding items that the bank included in the bank statement and put in our account that we have not recorded yet. Here's the note I talked about, and you'll find that all that is in the reading up here. You can read through this for the explanation. But the note itself was $2,800. The interest on that same note, $2,000. The bank collected that and gave us credit for that. The bank paid us $20 interest just based on our daily average cash balance. The bank took away $750 from our account because a customer check that we were given and we deposited turned out to be bad. So the customer's bank sent it to our bank, and our bank reduced it from our checking account. The debit card, someone used a debit card and it was not recorded. So it's easy to do that, to use a debit card and not record what happened. But we will see it on the statement, so we have to record it now. We'll do that in a minute. The electronic fund transfer for advertising, sent from us to the ad agency directly. They charged a service fee, and then here's an error. And since we wrote the check in our books for only $2,600, and it was really $2,900, we had that $300 error that we identified earlier. That's our mistake. we need to reduce our cash balance in our books by $300. After you make all these adjustments, we come up with $4,200. It matches, so this is reconciled. So this must happen every month. Start with the bank balance, reconcile it for items that we know about, the bank hasn't recorded, get a certain amount, a certain total here. Go to this side, start with the general ledger cash balance, make adjustments for items the bank has recorded already that we haven't, quite a few over here, but we end up with the same balance. So we must do this. If these two numbers don't equal, then there's still something out there floating around you have not accounted for. So there's going to be an error someplace. So we're satisfied here, but now what we need to do, if we have in our records that we only have $2,880 in our general ledger cash account, but we're saying we need to have $4,200, we need to get that balance up to $4,200. So what we're going to do is make several journal entries for all these items here. Don't make entries for the ones over here. Don't do that. Because these are recorded correctly. This will come through the bank. Don't make your own journal entries for any of these. Make journal entries for these items over here. And you have to pay attention to what each item is. You know, the note was $2,800. It had interest. The customer, the person who owed us money paid us. The bank paid us some interest. And we have these things that went out the door that the bank has already taken care of. So let's make these entries. Come down here. More explanation, and here we go. So what we're going to do is add to our cash account, increase cash for the note that came in. So we're going to remove from our books the note receivable, and that's where someone owes us money. We loan money to someone. They paid us the $2,800, and they paid us the $200 that goes along with that for the interest. That's interest revenue we've earned, from the note, and also we earned some more interest revenue from the bank account, our checking account. So we have two revenues, and we have an asset being reduced, the receivable, and that's because cash came in the door of $3,020. So these three items, let me go back up, are these three right here. So this is going to be only one debit to cash and 3 credits to these various accounts. Now we need to make an entry for all these. We're going to see quite a few debits for these, and then 1 credit to the cash account, because these reduced our cash account. Let's find that entry, and here it is. So in the reading, you'll see that the $400 electronic funds transfer was for advertising expense, so we record that expense. Accounts receivable, that is the non-sufficient fund check, the NSF check. So the bank gave us the check back and said the customer's bank account did not have enough money, and we're going to take this out of your account because we had deposited earlier, so they take it out of our account. Now we have a receivable because the customer still owes us the money. We're holding a bad check in our hands. We have to contact the customer and say, please pay us $750. So they owe us money, so we do increase accounts receivable. Now the supplies, we purchase supplies with the debit card. Let's get that recorded. The service fee expense for the bank charges, probably the monthly fee. That's an expense, get it recorded. And then the rent expense was that check that we wrote where we only recorded $2,600 as rent expense. It really should have been $2,900. So we need to increase the rent expense account $300. So cash is reduced $1,700. So let me go back up and just show you one more time. That second entry is taking care of all this. So that's why we have 1, 2, 3, 4, 5 debits and 1 credit, which is the reduction in cash. So there's the first entry to take care of that cash increase in our general ledger cash account. And then here's the second entry where we take care of the reduction in our general ledger cash account. Okay, so you'll have several examples to work through in the homework, and I'm sure you'll have one of these problems on the exam as well. I think that's it. They have another review down here. You can go through another example on your own time. Okay, that is the important part of the chapter. Don't worry about employee purchases, and don't worry about the cash flow statement. We're going to have a whole chapter later on that. And what else? Cash analysis. Let's don't worry about this at this point. So we've covered the main points. So good luck with your studies.